Guys, welcome to Core Academy. Guys, in this video, we'll be talking about financial management. First of all, we'll be talking about the definition, then we'll be talking about the important decisions which financial managers make in the financial management process, and what is the aim behind making those decisions. That is, what is the defining goal. So, talking about the definition, financial management is concerned with the acquisition, financing, and management of assets with some overall goal in mind. Before we talk about the different decisions, first talk about the goal. That's what is the goal of the financial managers when they are performing financial management. So their goal is simply shareholder wealth maximization. Their aim is that they make decisions and they take decisions in such a way that ultimately the share price, market price of the share increases, and which results in the wealth maximization for the existing shareholders. Okay, the goal is to increase the share price for the existing shareholders because financial management managers are working for the current shareholders. This is the goal. Now how do they achieve it? They achieve it by taking three sorts of decisions: acquisition decisions, financing decisions, and management of assets decisions. Now, what are acquisition decisions? Suppose that the company wishes to expand. Okay, now there are two options for the company: whether to acquire another company, or or to install a plant themselves. Okay, now these two decisions the company will have to weigh the cost, will do a cost benefit analysis. Let's suppose the company decides that okay, they are going to expand organically and they will set up their own manufacturing plant. Now, what the company will do before jumping on to the decision is that they will use various metrics to decide whether the plant will be profitable or not. For example, they will calculate the payback period. That is, if they want to invest, for example, 100,000, they are going to invest 100,000 in the plant. Then they will calculate payback period. That is, in how many years or months the plant will pay back the cost. They will also calculate the, let's suppose, the net present value, which is effectively the discounting the future cash flows, and see if the plant will be profitable in the long run or not. Okay, and if there are competing decisions, so these are capital budgeting techniques. Okay, IRR, internal rate of return, is another capital budgeting technique, and these are we will talk about this in detail in other lectures, but these essentially are the acquisition decisions. That is, managers are deciding or gauging as to whether the acquisition of the asset will be profitable for the company or not, and hence will result in shareholder wealth maximization. Now, let's suppose after the company has analyzed the new plant, and they calculated that the plant will be profitable for the company. It will result in positive cash flows and it will be profitable. Now the decision is that how will they finance that $100,000 which will be required to install the plant. Now there comes financing decision in the financial management process. Now there are essentially two ways to finance the decision. One is equity financing and the other is debt financing. And of course, if the company has funds available on its own, that is, it has retained earnings from the previous years, then it does not matter. They have internal funds. But most of the companies do not have internal funds to take such mega projects. So they will decide whether to raise more equity, that is, sell more shares and raise capital, or to take loan from the banks, that is, loan from the markets. Now, of course, there are various decisions at play at this stage, because equity financing is relatively expensive and debt financing is relatively cheaper. Debt financing also has tax advantages because interest is a tax deductible expense. So there is a balance, there is a trade-off. For example, when you do debt financing, the leverage of the company increases, and what this means is that the company might lead to bankruptcy in the extreme cases when the company is not making a profit, because interest on debts has to be paid regardless of the fact that the company is making a profit or not. Whereas this is not the case with dividends in equity financing. Dividends are only paid when the company is making a profit. So this is a trade-off. Another trade-off is that when the company has when the company is excessively leveraged, that is it has taken the excessive loans, then the cost of debt even increases, because banks will be charging more interest if the company is highly leveraged. They are afraid that the company might default in paying back the loans and interest payments. So there has to be maintained a balance between debt and equity financing by taking into account various costs. Now, once the company has acquired the assets through any financing mode, then comes the management of the assets. Okay, in as far as financial management is concerned, the management of assets is more about the current assets and not about the fixed assets. For example, the financial managers are not concerned whether the plant is working at its optimal capacity. No, they have already made that decision during the first phase, and that is acquisition phase. They calculated the profitability of the plant. Now it's up to the operational workers, that is engineers, whether they are operating it effectively or not. So that is not the domain of the financial managers. What is their domain is that they will be working on maintaining an ideal balance of working capital assets. For example, inventory, how much inventory to hold, how much cash to hold, how much to invest in short term securities. That is what management of assets means. So let's suppose that the company decides to invest a certain amount in maintaining the inventory. Let's suppose $10,000 of a particular product. Now there is also a trade-off when the company maintains excessive stock. This means that even though there is advantage that the company will not run out of stocks and customers will not be dissatisfied, but the company is holding its very valuable cash in stock. That is, if it were able to lower the stock level, inventory level, it would be able to invest that amount in some short-term securities and earn interest income on that. So once again, trade-offs. Remember, financial managers are always faced with trade-offs. Now, let's suppose that Christmas is coming and seasonal discounts are coming. So now the management will have to decide how much more short term inventory levels it will have to maintain, and of course it will have to decide from which mode of financing it will raise cash to purchase additional inventory. Now these are the short term fluctuating working capital requirements. That is, once the Christmas is over, stock levels will fall back to the normal level. So usually what financial managers do is that they finance the fluctuating capital working capital requirements with short term financing, and the normal or the fixed working capital with the long term financing sources like debt or equity. Okay, so these are the essentially key decisions which financial management these are the three financial management decisions, or these decisions are come under the ambit of financial management, and these decisions are taken by financial management, and these are acquisition decisions, financing decisions, and management of the assets decisions, with the overall goal that the wealth of the current shareholders is maximized. I hope you liked a lot of things from this video and learned a lot of things. If you did, then do subscribe to the channel and give a comment. Thank you.